Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today, I want to answer a question that somebody posed on Twitter. It deals with the thesis, and I keep getting these questions over and over and over. I'm in the commodity bull camp. Why am I in the commodity bull camp? How does this all fit together? What does it look like? And I'm just going to lay it out all in one clip here with a bunch of data. I am data driven. I look at history. I look at charting. I use charting because it's a non-biased opinion of history. And we can see how humans are interacting with each other by looking at technical analysis patterns. So I'm one big hybrid. I'm a hybrid of fundamentals, history, data, and technical analysis all merged together. So that's what we're going to do is we're going to look at everything merged together. And you're going to get a whole bunch of my opinion here on answering this question here. So let's dive in. I'll give you my financial opinion. I'll try to explain my best of what I see in the markets. And I'm also going to explain kind of where we are in this cycle. And again, this is just my opinion. You can debate my opinion. So don't take everything at face value. Take it and research it yourself and make up your own opinion. So this is the question here. It says, so at Finding Finance, if you always say we're going to have a commodities pricing going up, I'm not saying we won't, then doesn't it mean inflation rising and then interest rates up and then deep recession, which will ruin the demand eventually? So that's the question that spurred all this. And I'm going to give you a very long-winded answer on all this data to support what I'm thinking. So people were asking also, what causes money rotation? Because I talked about it in the lead lag report when I spoke with Michael Guyette. I spoke about money rotating differently and whatnot. So I'm going to go over absolutely all of this. And hopefully I can answer a whole bunch of different questions that people have. So I've got TradingView up, and I've got the S&P 500. That's right here watermarked. And then under here, I've got the housing starts. Housing starts, I think, and the demographic, and I don't have the demographic percent change. I do have that somewhere in there, but the housing starts is really what rotates money differently. And what we can see is I've got these highlighted areas, commodity booms. There was one in the 1930s, 40s. There was one in the 1970s, late 60s, 70s. There was one in the mid 2000s. And then there's one, I think, coming up now that have started. And there's some similarities between each one of these areas, and I'm going to give you my opinion on what the driver is of the commodity booms. And I'm going to zoom in on these last three because that's where we have the data. So if you look at the commodity booms, there's some things that stick out. Big, gigantic expansionary phases of real estate. A demographic came into home buying years during the 1960s and 70s, known as the baby boomers, and increased the credit in that system. They're also coming and they spend more money during those years as well. They buy couches, they buy cars, they buy all sorts of stuff. Money velocity kicks up. And when this all comes into play here, your interest rates chase that inflation higher, and then the S&P 500 goes sideways for a period of time. The reason is they're still earning more money, but the PE multiples are going down on the S&P 500, given the higher interest rates. So people are less willing to speculate in the S&P 500 or the NASDAQ when interest rates are going up. So generally the market goes down, especially if interest rates are going up at a fast pace. It's basically repricing assets in the market. So when we see these gigantic expansionary phases of real estate, especially all in a row, and there's an and there, and you've got the right market conditions where you have commodities cheap and the S&P 500 expensive, things get repriced differently. And that's the exact conditions we had in 1970, basically right here, where all of those things started to reprice each other. We had all of this kind of line up for that type of market conditions. Now, it happened again you have to keep in mind here, though, people will say, well, what about this one? The S&P 500 really got cheap in this general vicinity here, and commodities got expensive. So when we looked at it, we had the ratio favorable for the S&P 500, and the intensity tied with interest rates coming back down as well. All of that changed, and interest rates came back down, and everything got repriced higher for the S&P 500, and that's that great repricing. Obviously, the S&P 500, their earnings were growing, but they were also gaining price with a higher price to earnings ratio. So it was all of those things going on together, where the S&P 500 made an epic bull market run. Then we went into another expansionary phase of real estate. It's a big one. And what happened? We went sideways on this for a while. So the driver of it is money coming into the system, credit expansion from the real estate market, pushing interest rates or pulling interest rates higher a little bit. And then you see this sideways motion in the S&P 500 as that gets repriced differently under an increasing interest rate environment. And we're also doing that here. We're coming into an expansionary phase of real estate. We saw this pull on back. Now, this cycle here is very much jacked up. And why do I say that? Well, they shut down the economy completely for 2 months in 2020 down here. Then they opened it all back up. They threw a bunch of stimulus money in this mix. And our leading indicators, which is lumber and all these other things, they all got jacked up. Why? Because they stopped it, then they started it, and then they put a bunch of money in the system, and things have to stabilize for a little bit. It may take a year or two for things to stabilize. And I think that's what we're doing, is we're going through a stabilization period. Now, I think that we are still in an expansionary phase of real estate, and that this is basically the same as what happened over here. So we came on up, we came on back and touched basically the average home builds. And what's coming is this, potentially. Now, why do I think that? I think that if you lower interest rates, the housing market will kick back on. That's what I think. And I'll show you data that it's starting to do that already. I also think there's going to be a normalization where people are like, oh, this isn't affordable. And they're going to realize that interest rates may not come back down to the level that they were in 2020. So I think there's a combination of psychological change of the participants and of the demand. And I also think that interest rates will come back a little bit. So it's a combination of those two things. Now, this doesn't mean that this can't go higher. We could go higher and bounce, for a while sideways, like we did in the mid 2000s, like we did in the 1970s, et cetera, et cetera. Now, here's a bunch of information gathered in the markets right now, just to show you where we're at this second. So I'm going to this presentation here, and I'm going to start off with this. All right. We've got a couple of different areas. There we go. I'm going to start here. We've got a couple of different areas that money is created from. One is created by the government, and the payments and obligations that the government has. And this is some of the payments and obligations that the government has for the United States. The other portion, and I'll go over this here, is the real estate cycle. That's where credit is also comes into the system and money's created. That is the credit money side, is these two slides there. When you look at this and you look back at, say, 2018, we were at what, 4.75? So that's in billions, 4,750,000,000. And if you look going forward in 2032, we're up above 7 trillion, 7.25 trillion maybe. So we go from almost a double from 2018 to 2032 in the expenditures of Social Security, health entitlements, and interest costs drive 86% of the 2032 spending hike. Now, you have to keep in mind, though, what happens if interest goes up? And this is miscalculated, because 965 is really happening in 2023, 2022. So we could see a much larger interest expense on the debt when we roll these debts over or release new debt. And this could go up higher based off interest rates. All of this is inflationary. It's all inflationary. So this is one of the drivers of inflation coming into the system of all these payments. Now, some of this isn't inflationary. We'll say, it depends what your tax revenues are and all that. And other portions are inflationary. But this is an inflation driver if you're doing deficit spending. The other portion is the 18-year property cycle. And I think that we're somewhere in this mid-cycle slowdown. That's where I think we're at. Now, what makes this difficult, and I'm going to go back to the other one, what makes this difficult to see is some people will say that the mid-cycle slowdown was, 2020. But here's the thing, though. I don't think that's the case. The reason I don't think that's the case is this is a man-made shutdown, which created this cycle adjustment, so to speak. I don't think that's the case. I think the mid-cycle adjustment is driven by interest rates, and I think it's over here. Interest rates also impacted the mid-2000s over here as well. It was the interest rates coming up, and then they lowered the interest rates, and we took off in the housing market when they lowered the interest rates. They also threw in crappy loans all through here. Now, I don't think we're in the same situation. We don't have those crappy loans in the system at this time. I'll show you data on all of that. And I don't think this is the mid-cycle slowdown in 2020. I think we're happening when the interest rates kicked up, and we're doing it right now. Which means, if that is the case, and I could be wrong there, that we actually still have a gigantic amount of upside in the real estate market. And I know that goes counter to everyone and what people are saying on YouTube and Twitter, all the bears. I understand that. But I think we're in the mid-cycle slowdown, and that we actually have lots of home price appreciation ahead of us, given where the interest rates are at, where they actually end up for affordability to some degree. Now, why do I think that? So I think that because depending on who you ask, experts believe there's a nationwide housing shortage of between 2 million to nearly 6 million newly built homes. And that was October 26, 2022. It says the U.S. housing shortage is likely to worsen, experts predict. And real estate trades off supply and demand. Interest rates is a factor of affordability. Interest rates can slow things down. Interest rates can speed things up. If that pressure is there, what happened when they did QE in 2020? We saw house prices take off like a raped ape, so to speak. They just went moving quickly. And the reason is because we have a shortage of homes, and we need to build all these new homes. All those new homes is future inflation. They will get new loans against it. And those new loans means more new inflation. And that's where we see as those big housing expansion phases have big, large commodity booms that I showed you earlier. So if I were to just kind of tie back into it to show you guys, if I were to back out, the housing booms here have commodity booms. And we're going into another commodity boom. And why is that the case? Because the credit coming into the system from the housing market puts everything into a shortage. It puts it all into a shortage. And that shortage is what drives the expansion of commodities, new mines, new whatever. Now, in 1970, we had a large bull market in commodities and precious metals. And one of the reasons is we tried to expand our oil supply, and our oil supply went in the opposite direction. We hit peak oil. And we had to expand into worldwide oil production capacity. The problem here that's coming up is we are going to exceed worldwide oil production capacity soon. And I think that's going to be a major problem. I also think we have other problems in other commodities, and I'll show you what those look like. But we have a housing shortage. The pressure is there. What does that mean? It doesn't mean that house prices just go straight higher. It does not mean when I say the pressure is there, that interest rates just go straight higher. It doesn't mean any of that stuff. And when people hear me say that, they make up of what they think I am saying. What I am saying is the demographic has pressure, which means there's people there to buy new homes to have prices remain resilient. It doesn't mean that prices have to go higher if they raise interest rates dramatically. It just means that there's this constant pressure of people wanting to buy homes, wanting to start families, wanting to have kids, wanting to increase the spending of buying new couches, buying new cars, buying new everything, all right? That the pressure is there. Doesn't mean that pressure can be executed under certain market conditions. Now, what we saw recently, this is just an updated chart here, is we saw rates come down a little bit from 7 to 6, and we're starting to see refinancing applications kick up. We're starting to see purchase applications kick up, where we could see higher increased new loans coming into the system. Now, I don't know if this is a bottom. I'm just saying that it's kicking up a little bit. It's something to watch. When you look at real estate loans from all commercial banks, this to me does not look like a peak. It looks like it's starting to get heated up. And that's probably why they're trying to hold interest rates at a high level. That is Jerome Powell and the Federal Reserve, because they're trying to slow the real estate loans coming into the system. But we've got higher home prices, higher interest rates, which means bigger loans. Bigger loans, more money coming into the system and more credit being created. This was the credit destruction that people saw as a housing market crash from 2008 onward. So this is 09, 2010, 2011. That's the crash from the real estate market. And I'm going to show you data behind this, showing you what the data is and why I'm making the decision that I don't think we're in the same situation as 2008, 2009, 2010, and so on. But that is where the deleveraging of the housing market created that crash. So we are moving on higher in all real estate commercial loans, and I don't see the delinquencies and the stuff coming in the market yet, and I'll show you all that data. Here's the active listing count. This is your inventory in real estate. Remember, this is an important portion. Real estate is a driver of credit expansion. So we're at 689,000 is what our current active inventory is right now. Yes, it's up 55% year over year. People are going to say it's up 55%. The whole market's crashing. Well, it's all relative, guys. You need to understand where we are from an absolute inventory level. So 689, let's just say 690. 690 is down here. We're down here, and that's compared to history. Our inventory levels of 690,000 is basically lower than any time in history. And people are saying, oh, this is bearish. How is that bearish? 2008 had 10 months of inventory. 10 months of inventory. 10 months of inventory. Okay, so I should say 689 is about 2. It's about 340,000 per 1 month of inventory. 10 months of inventory is 3 million homes. We're at 690. 690 is not anywhere near 3 million homes. Back in the other markets in 2017-18, we were around 1.2 million, which is still incredibly low. It's about 3 months of inventory or so. 3-4 months of inventory. So we are 4 months at 1.2 and a little bit below that, 3 to 4 months. We're still below. These numbers here are still below everything before in history of the lowest inventory levels. So we're at incredibly low inventory levels for existing real estate. The crash times come when you get above 8 months of inventory. 8 months, 8 months, 8 months. These are crash level areas. That is when you really have to worry. We're not even near an average market yet. And I understand some cities may be, other cities may be incredibly low. I understand that, and it is regional and is based off city by city. I understand that. I'm talking about an aggregate level of the entire United States. Here is your delinquency rate on loans. Your delinquency rate kicked way up before the peak of new home builds. So if you look, 2006, we were rocketing higher in our inventory levels. We were rocketing on higher. We also were rocketing higher on our delinquency rates. And our delinquency rates started to kick back up. And that's what we're looking for. But we're not kicking up on our delinquency rates given the latest update of November 23rd, 2022. They are incredibly low. So our delinquencies and our foreclosures are not in the system, and they're not, the delinquencies are still at all-time lows. So we have all-time low inventories, which are down here, lower than any time in history, and we're at all-time lows for delinquency rates on loans. That does not spell trouble, to me at least. Now, you look at lumber. Lumber is the new home builds yanking lumber, and usually what happens is lumber goes higher when more new homes are trying to be built. So think of it as a new housing market boom, lumber prices go up. Now, the thing that's difficult here is we shut down the economy in 2020, and then we juiced the economy. They did QE, and of course, all of that combines going to spike lumber prices because everyone bought a bunch of new homes. They wanted to get all their mortgages set. They were doing QE. They got more money in the system. They got more money in their checking accounts. Of course, it's gonna explode lumber prices. But now it's starting to regulate, or I should say normalize, and we're coming back to an area where basically it's a retest of the breakout. So we broke out. We're coming back to do a retest, and I think we're going to find support and move on higher for lumber prices. And I think more new homes are going to be built, et cetera, depending on interest rates and where interest rates eventually normalize at. We look at the home builders. This is the home builders ETF. They're putting in a bottom here. So we've got one bottom, double bottom, and we're starting to break out of that. We'll call it the neckline or whatever you want to call this, to the upside. And this could be a nice move higher for home builders. Now, my question is, by painting the technical analysis together, we've got really low inventory levels. We've got very low delinquency rates. We're starting to see the rates come back a little bit, and we're starting to see the housing market purchase applications start to come higher. And at the same time, we are seeing a retest in lumber of a breakout, starting to move higher, pulling out of a falling wedge to the upside. And we're seeing home builders break to the upside here. So does that look bullish or bearish to you, given that information? In my opinion, it's bullish. I don't know where the bears are getting their information from. All they're looking at is the percent change of year-over-year inventory levels. It's worthless. Sorry, it's just not something to look at. Now, how are they handling the inflation? The Federal Reserve. This is the U.S. Big Three: crude, gasoline, and distillate inventory deficit to the 4-year average. We are declining our inventory. We're declining our inventories of crude oil down and down and down and down. Now, this is the inventories. This is our deficits that we're running month over month. This is our OECD total petroleum inventories. So this is our deficits that we're running on the 4-year average. So we're eating. And then this is our total petroleum inventory. This is our SPR releases that brought our inventory back to November 2022 levels here. This is the SPR oil. Otherwise, we would have came all the way down to this red line down here, which is the gap. This gap between where we are versus down here. Now, that can be an incredible amount of oil price, given our inventory levels were moving down at that rate if the SPR releases never existed. But they do exist, and they did hold our oil prices way lower than what they're supposed to be at. We should be in triple-digit oil prices right now, turning on more supply. But what they did with the SPR was hold the price levels down, and they're turning off new supply in the future. And if we were to look at the SPR releases, this is what they look like. They started in 2020. They released some oil. They came on back up, released more oil in 2021, and then they really hit it here when oil prices started to take off, and they just flooded the market. That is what kept oil prices low, and oil price is a translator of inflation into the consumer price index. They're manipulating it based off the U.S. Strategic Petroleum Reserves. So what I'll say is, and why I'm so bullish on commodities, is that the prices never turned on new supply of any of these commodities and or oil. So the deficits still exist. That's what this deficit is. The deficits still exist at ever greater quantities at prices that shouldn't be this low. That's why those deficits exist so large. Prices should be far higher than where we are today. And to solve the deficits, we need to start pricing this and getting it back up. But right now, since they use the Strategic Petroleum Reserve to manipulate the price lower, the demand isn't getting killed and the supply isn't coming on as fast as higher prices would dictate. Here is a long-term chart of the crude oil price. And I grabbed a lot of these charts off of Twitter. This is a channel going down. We've broken out. We've done a retest. Everyone on the channel knows what I talk about on the retest moves. You buy the retest move. So that's where I think a good entry point is. And we know they tried manipulating it with the SPR releases. So where do you think oil price is going to go? They're going to go higher. They're going to jump off this support level and jump to the upside. How high? I don't know. If I were to guess, $200, $300, $400. That's my guess. I don't know if it's going to get there. Maybe we do 180. I don't know. We're not going to be at $81 though. And it's going to take probably the back half of 2023 is when it's really going to get moving and start cooking to the upside. So how did they manipulate the 10-year yield, the dollar, all this stuff? It's all tied together to this release. This release of Strategic Petroleum Reserves caused a pullback in oil prices, which also is causing a pullback in the U.S. 10-year yield. Yes, that is correct. So we were going vertical here, and they said, slow this thing down, dump oil, flooded the market, and then rates came back on down. I don't know if these rates are going to stay down here. I think they're going to probably kick back up. Perhaps, based off of where I think oil is going to go. The dollar also fell because our monetary tightening is not as tight against other currencies. So it's relative to other currencies. And then gold likes this, where you get a real negative rate, a declining interest rate, declining dollar, and gold loves that. But I don't know how long this will last, and I think gold can go up even in different market conditions, much like the 1970s. Gold can get scared, and people get scared out of bonds, and they'll start buying other assets. That's the rotation of money. The rotation of money has kind of slowed down because they did this Strategic Petroleum Reserve release and slowed down the interest rates, the 10-year yield. Now, those interest rates coming back down here, these interest rates and the mortgage rates that I showed you, they came from 7 to 6%. Look what happened. Mortgage demand jumps nearly 28% in 1 week as interest rates drop to lowest points in months. Mortgage rates are at the lowest level since September, bringing on new demand into the mortgage market. The average contract interest rate decreased from last week to 6.23 from 6.42. Applications for mortgages to purchase increased 25% week to week, but were 35% lower than the same week 1 year ago. But it is coming back online. It means that the demand is out there. It's just an affordability problem. That's what I'm using this slide for. That's what I'm trying to project here. The pressure's there. It's just the affordability is hurting people at this time. Now, we know that they use this Strategic Petroleum Reserve release to kind of tamper down inflation, tamper down yields. We know that this is basically aligned for a much bigger move to the upside. We've got a falling wedge, and we broke that to the upside here recently. What about the situation in commodities? Now, these are base metals and all these other base metals. We have huge problems out ahead of us in terms of deficits. Here's the London Metals Exchange total registered stocks. This is for end of year stocks added together, cumulative, of aluminum, copper, lead, nickel, tin, zinc, and aluminum alloy. Look where we're at. We're at an inventory level that is lower than any time in history going back to 2002. So we have very tight inventory levels. What you would think is you would see all of these areas start to produce far more product, right? Far more aluminum, far more copper. We should be turning this on. Well, what about Chile's copper production? It's declining. Why would it be declining if prices are higher, right? This is the nation's copper output has been declining since 2018. Maybe we've hit a peak in Chile's copper production in 2018 and we can't bring more copper online. We need new mines, or maybe the mines don't exist, period. Maybe the ore grades are too low and they're not profitable to bring online. Maybe the mines do not exist at the current prices. Either way, it doesn't matter. Production's falling and we went from 13 billion pounds down to below 12 billion pounds for Chile's copper production. This is the big boy area of production. What about aluminum? It says the deficit's now moving at such a speed that it's unsolvable, actually, he said. It says out of aluminum, Trifigura says global inventories will be exhausted by early 2024. And look at the deficits here. Global aluminum inventories run massive deficits moving past 2023. 2023 is that inflection point. Now, you tie this all together, we're short on oil, and oil is a huge input for creating more production of commodities. Now, we look at this as how many mines do we need? And this is just for the renewable spots. These are the number of mines plants needed. So it's 1, 2, 3, 4, 5, 6, 7, all these added together. This is 2022 supply versus 2035 demand. And this is the gap and this gigantic gap that we have in mines needed. And this is for lithium, cobalt, nickel, natural graphite, and synthetic graphite. You need massive amounts of number of mines and plants needed to create this world that everybody needs. And what are we doing? We're releasing strategic petroleum reserves, holding oil inventories to a certain level and holding oil prices down where we can't kick on more oil production. This here is all future oil production, or future oil demand, I should say. All these mines, all this stuff, it needs aluminum. It needs copper. It needs all these things in order to build all these mines. And guess what? We're going to be running massive deficits, and we want to build a whole bunch of new stuff. It's a problem that I don't think we've ever seen as a human species. Now, here's some other charts. This is uranium. This is from North Star Bad Charts. Uranium preparing for takeoff versus U.S. equities. Boom, the launch from early 2000s all the way to 2007. And now we've got another early breakout line that we've basically broken out. We're ready to launch higher. So what I'm trying to say is we've got shortages in commodities. We've got the driver of inflation coming from the real estate market. We've got another driver from deficit spending in the government portion. And we've got unprecedented, I like using that, unprecedented shortages or deficits in commodities. Commodities are putting in double bottoms, ready to launch higher for uranium against U.S. equities. We're seeing Brazilian to U.S. equity ratio go up. So this is another thing that was basically signaling a weaker dollar and outperformance of commodity-rich countries. Same thing. This is an inverted head and shoulders. Shoulder, head, shoulder, ready to break higher and soon to be a downline trend break. So that is Brazilian to U.S. equity ratio. We're seeing that bottom. So we've got these. This is evidence of the markets agreeing with what I'm telling you. That's why I'm showing you this. Double bottom in uranium versus U.S. equities. And that also ties with this that I showed you earlier. I'm trying to tie this all together. It also ties with these consolidation periods where I think we're going to have a consolidation period in the S&P 500. It also ties together with the housing market going into an expansionary phase. It's all interlinked. So this is more data of humans basically putting in bottoming patterns in commodities versus U.S. equities Brazilian versus US equities. We've got a Jesse Livermore cylinder in a uranium company, Camco, which is the largest uranium company, breaking to the upside, ready to just rip it. That's more evidence. We've got, this is a diversified mining company. I don't have the label on it. That's breaking to the upside of a 1, 2, 3 hump. Notice that there's always 3 humps in a consolidation. Consolidation, breakout, retest, breaking higher. So that's also showing us that the markets are lining up this diversified mining company. Here's an energy service company. I'm not sharing the ticker symbol. Shoulder, head, shoulder, bottoming pattern, and then the break. Shoulder, head, shoulder, bottoming pattern, ready for the break. We are seeing evidence in the markets all around in all of these commodities. And it's not just these single companies, it's everywhere, putting in double bottoms, inverted head and shoulders, in energy service, energy, uranium, copper, diversified miners, zinc, tin, aluminum, etc., etc., etc. Now, here's another thing. We might not be the driver of all this. China is getting larger, and they might be driving some of this. China also just went through a kind of a deleveraging phase in the real estate market. And right now, mortgages are the cheapest they've ever been because they went through a crash. When you go through a crash, your interest rates go down. Your house prices go down, your interest rates go down, everything kind of crashes. And right now, they're re-stimulating their economy. So they put stimulus money, their mortgage rates have never been this cheap, and it's going to kick back on. So they might be a larger driver for a commodity boom than what most people think, especially if there's deficits in the market with commodities. And here's something else that's also kind of weird and funky. It says the annual change in M2 money supply has been negative. Now, I know they created a bunch of money. They bought a bunch of assets. I don't know how this works with so much manipulation in the market in terms of money supply. They created a bunch of money, and some of it went into the system, some of it did not. Is this money that's coming out of the market, is that the Federal Reserve balance sheet just coming off and they're marking it down? I don't know. But I don't think the M2 money supply is contracting from the real estate market, which means money that's rotating in the system, circulating in the system, is still in the system. So that is one thing to note. I just wanted to note that. Another thing, this is the broad overall market S&P 500 index. We are seeing the percent of stocks above 200-day moving average is bullish on the SPX. You can see your double bottom. You get the lead in, double bottom, the breakout, the retest, and then we usually get a break higher. So we are seeing a bullish sign in the S&P 500. And I don't only just look at commodities. I look at everything. So we're seeing that is bullish for the S&P 500. We're seeing that it's bullish for the communications index fund. That's also another double bottom. And then we're breaking to the upside. We're seeing copious amounts of money being created over at the Bank of Japan. So this is the Bank of Japan balance sheet. They are buying bonds massively. They have a bond problem over there. I think that bond problem is going to probably circulate around the world. So I think that there could be more inflation coming from countries trying to save their bond markets. We could probably see England, we could see Japan, we could even see the United States do QE again, because there's just no buyers for these bonds. And what that means is that people will be selling bonds and buying probably the real thing, hard assets, which is going to be that rotation of money. The rotation of money is moving away from bonds because of interest rates going up. And I think it's going to move away because of the fiscal tightness in the commodity markets. It's going to be very tough for companies to make products, especially very complex products, if their commodities are not available or if they're very expensive. So it really depends on the pricing of the products and the affordability of those products. Now, here's aluminum. This is the price of aluminum. I just threw that in there. This is also, we're seeing all of these charts where the commodity prices are breaking. They break out, they do a retest, and then they break and move higher. This is an inverted head and shoulders bottoming pattern that's going to move higher. We're seeing it across the board there. So I wanted to kind of touch on all this, all right? A lot of different things, all of this data kind of tied together, and that's how I view the world. Is I take a bunch of different data, I tie it all together, and it paints a picture. What does that picture paint right now? The picture is painting that the real estate market is just an affordability problem. It's not a blowout crash problem. A blowout crash problem means that you can lower interest rates and demand does not come back. It is oversupplied. So when you get that oversupply, basically homes are coming into the system faster than they can be absorbed. We're not seeing that in the inventory numbers. We have very low inventory. Right now, everything's just paused. It's paused because of affordability. That's my take on it. When the interest rates come back down, what happens to the loans? They kick back up. That is evidence that it's an affordability problem, which makes me think that we're in the middle of an expansionary phase and affordability is the issue. Now, are interest rates going to come back down or are they going to go back higher? I don't know. That I don't know. We'll find out here. Powell's going to have to keep those interest rates high, but if he keeps those interest rates high, what happens? The interest payments on the debt rolling over and all those new releases, he's going to have to deficit print and pay for that interest. They're screwed either way they go. They lower rates, we get inflation from the real estate market. They leave rates high, we get inflation from the interest deficit that they have to spend to cover the interest payments. All of these charts are signaling bullish bottoming patterns and breakouts in commodities and even in the overall market right now. I don't think the overall market's going to last forever, but I do think that commodities are going to start to make another move higher. So that's kind of what I see in the market summed up with all these different charts. That's how I view it. I tie all these charts together and piece it into one big picture. So that's what I've got. Hopefully you guys enjoyed it. Give me a thumbs up for the content. If you guys need help in this commodity bull market and learning this stuff, definitely check out finding-value.com, become a platinum member. You can use the word discount in the coupon code, get a discount. And you can learn all this stuff with me. You can also see how I'm positioned in my portfolio. You can see the companies. I do a lot of analysis with fractals, and the fractals really determine what I think the potential move could be in a individual company. Think of it as genetics of that company, and we can see that through the technical analysis and through the chart patterns and the volatility and how big they move. But that's what I've got for today. We'll catch you next time. This is Finding Value.